And just like that, we're back. We're so back. The S&P 500 continued its move higher on the back of everything rallying today. But is the move justified? Because durable goods data dropped pre-market and things came in a lot hotter than expected, but the market rallied regardless. So is this a bull trap waiting to unfold, or has the market completely lost the plot? Today, we're going to discuss that and take a deeper dive into Nvidia, stock splits, share buybacks, dividends, and the overall value you can extract as a shareholder from the market. And of course, the S&P 500. The weekly candle just closed out with a shooting star doji, and often this is an ominous sign. So we're going to talk about where the S&P 500 will go next, and we're also going to look at key levels. Will the momentum continue, or will the bears finally take us lower? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. So guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment in the algorithm. It really helps me out. Let's get into it. This is a daily heat map of the S&P 500, and it was a very green day, not without a little bit of volatility. Home Depot, home improvement took it on the chin, as well as farm, railroads, and integrated freight in industrials. We saw a couple of big names in software application. Intuit and Workday reported very average results. In fact, it was very weird year for Intuit. You know, management guided for 11 to 12% revenue growth for the year. They increased that to 13%, but still fell 8% on the day. So I think the street wanted a number a little bit bigger than 13%, but it actually was a double beat and raise for Intuit, and that did affect Salesforce right here, as well as ServiceNow, and then some of the smaller names, Cadence Design Systems, Roper Technology, Autodesk, put out relatively flat / slightly down days, and that's why software was the worst performing sector in the market today. Also, defensive sectors were sold in light of growth. Look at staples, red in this section of staples, not so much Walmart, Costco, and then healthcare plans, as well as drug manufacturers, the real defensive sectors of healthcare, really taking it on the chin today. But other than that, the big boys participated: Meta, Google, Apple, Microsoft, Nvidia, and not just the mega cap 7. Look at stuff like JP Morgan, Bank of America, American Express, Berkshire, Tesla, GE, Walmart, Costco. You know, the big names in each of the sectors really did outperform today, and that really led to just overall positive sentiment in the market. We saw the S&P 500 was up 0.66% here today, and the best performing sector was semiconductors, followed by GDX, then XLC Communication Services. The worst performing sectors were software and healthcare, and then real estate actually had a flat day, 0% gain on the day, and then every other sector was positive, but the real outperformers, tech names, gold miners, discretionary as well. Now, equities did have quite a bit of tailwinds, and it had to do with durable goods. Now, if you actually have a look at the consensus versus the actual, durable goods actually came in quite hotter than expected. Consensus was negative 0.8. Durable goods for the month-over-month April figure came in at 0.7%. Very hot figure. Ex-defense 0%, ex-transport 0.4%. But the actual March figures got revised down, and that's why market sentiment was actually quite bullish on these durable goods figures. At the same time, Michigan consumer sentiment also came in at 69.1. We were expecting 67, so you know, a slight move up in consumer sentiment, and that was a little bit of a tailwind for equities here in the S&P 500. But let's hop on the charts. Now, the move in the S&P 500 right here today wasn't all because of durable goods and Michigan sentiment. We also had a bearish engulfing candle, and we did put in a low at a very key level. If we actually pull up the US 500, you could see that a key level we've been talking about all week was actually 52.49. We actually bounced right off there. And so part of the reason why we actually did move up in the S&P 500 was just a bit of a relief rally coming off yesterday's sell-off. It was actually a pretty crazy sell-off when you think about it, down 0.77%. However, peak to trough, we're looking at a 1.71% down day for the S&P 500. So when you have a vicious down day like that, you obviously are going to get a red day. But what the data did do today was actually put pressure on yields. Like we've been saying over the last couple of days, that 4.5 is going to provide strong resistance here for the 10-year yield. We actually did see that resistance come in quite significantly. We actually saw it coming yesterday as well with this wick. We did move up to the 4.5 level and then pull back here in yields. We actually saw bonds overall did gain. Now looking at Bitcoin, up 1.26% year in the after hours, but next week is going to be a very key week for Bitcoin. It's going to decide if it moves back up to go and test this high, maybe break above new all-time highs, or if it's going to continue lower towards this trend line right here, where we might go bounce or we're going to break lower and continue the downtrend, make lower lows. A lot is dependent on Bitcoin right now, but overall, this does look fairly positive. You can see buyers are coming in at this level right here, and it does look like it wants to go higher. I mean, if this is low and we do push higher in Bitcoin, then we've formed quite a number of higher lows. Very, very positive, coupled with the fact if we do break this high, hit new all-time highs, that would be very, very bullish. A lot of sentiment around Bitcoin, especially with what US Congress is doing. So technicals are aligning, fundamentals are aligning, and I guess you could say the macros are aligning there for Bitcoin as well. Gold seems to be doing its own thing until the 2300 level is broken. I don't see much downside in gold. I think we find support somewhere here and then move higher. But if we do break below the 2304 level, it's looking a bit grim for gold. Very much the same trade here for silver. If we do break, go to as low as 27, possibly 27.25 in the silver trade. And looking at oil, it was up 1.1% here today. Biden is still selling a ton of the SPR, but finding support at 76. We'll see what happens next week. Now let's actually talk about the S&P 500. Now we're going to look at the weekly chart simply because the weekly chart has officially closed. And you can see that we have what we call a shooting star candle. We were actually slightly down for the week, by the way, in the S&P 500, down about 0.05%. But we did actually go and make a new all-time high, a wick high in the S&P 500. And we did actually, on the daily chart, go ahead and actually close at all-time highs here in this week. So very, very positive. We are in an uptrend, making higher lows, making higher highs, and making new all-time highs in the S&P 500. This is very, very bullish. I mean, earnings, the macro, the fundamental, everything is pointing to the S&P 500 to continue to move up. The only thing working against the S&P 500 is probably its relative valuation, stuff like its PE, sitting at historically high levels. But I do think once the market starts to broaden out with earnings, we should see that compress. And on 2025 earnings, it's trading at about 18x. Now, I know that's looking quite a bit into the future, but you do have to look at it that we are trading at a reasonable valuation relative to next year's earnings. Now, we are in an uptrend. There's not much to say here on the weekly chart. Now, let's assume we do get a pullback. What levels are we going to look at to buy those dips on the weekly chart? And where do we get bearish? Now, if we actually zoom out, a level we've been looking at for a very, very long time, since December, is this level right here. The reason why this is absolutely a key level is because we use it as resistance right here. We use it to support. We had this massive breakout into new all-time highs for the S&P 500. So until we actually pull back to this like 4,700 level-ish here, this is where I would only really start to get bearish into the S&P 500. But at this point, I would probably also get bullish. It really depends on what the macro environment is going to look like at the time. Now, to get to this level, if we actually were to sell from where we are right now, it is about a 10% pullback. So very, very possible. Now, another key level that we can look at before reaching this 4,700 area is actually just the 5,000 level. I think if we are to pull back on a weekly chart, we could get to this level, use our support, and then move from there. Especially if we put in like a higher low, that would be very, very bullish. Go ahead, make new all-time highs, and then it just looks like a trend continuation. So these are the two key levels on the weekly chart I would look at if we do get a massive sell-off. Now, looking at the daily chart, you can see where these key levels line up. So this was actually the low right here, and 5,000 is probably a great psychological level to enter longs if we do ever get there. But what about for the rest of the week? Now, let's actually move to the US 500 chart really, really quickly. Now, for the week ahead, again, same levels like last week. 5250 level is the key level we want to look at. If we do pull back to here, we should find support like we did this week, and then move higher into 52.95. This is the gamma flip zone. And once we're up here, once we're above the 52.95 area, we want to aim for the 5400. We want to buy dip, sell rips to the 5400 area, particularly starting on Wednesday and Thursday when we exit the window of weakness. Below the 52.95 area, we actually want to look at dip buying opportunities in this area. If we do get below the 52.50 area, I will update you guys as to what happens next, but I don't think that's going to happen next week. The bears had the opportunity to take us lower, and they simply could not. The fact that we sort of like traded sideways and then had this massive red candle, we actually worked off quite a bit of the overbought conditions here in the S&P 500. And now that we're above the positive gamma zone, very close to all-time highs, I think we'll make another all-time high next week, and we just continue to trade up to the 5400 area. So that's what I'm looking at next week. You want to be buyers of dips in this areas and buyers of dips and sellers of rips to 5400 above the 52.95. Now guys, diving into sentiment, this was the weekend poll from 5 days ago. This time I thought I'd show it to you guys at the end of the week just to see the outcome of the S&P 500 and what you guys voted at. So 55% of you were bullish, 30% of you were bearish, 16% of you you were in the neutral camp. And in my opinion, this right here is a lazy vote. So the next 16% of you guys pick bearish or neutral. Let's not do this shenanigans where you don't pick a side, have some balls. But had you been a complete bull for the end of the week, it could have ended badly for you. There was quite a bit of drawdown, quite a bit of drama there on Thursday, which inflected into here on Friday. But if you were bullish into Monday, Tuesday, Wednesday, you certainly did sow those rewards. And if you were bearish towards the end of the week, it was your week. All in all, I wouldn't call it a neutral week. Had you picked a side and picked the right time to join that side, you would have been very profitable this week. But as a long-term investor, this shouldn't really concern you. You should really just be bullish and go from there. But looking at other sentiment measures, 82% of FMS investors expect the Fed first rate cut in the second half of 2024. The question posed here by the Global Fund Manager Survey is, when do you expect the Fed will have its first rate cut? And you can see 43% and 39% of FMS investors, which is just fund managers, said in the third quarter, fourth quarter of 2024. So the majority of fund managers do believe we will get a rate cut this year, and it's going to be in the second half of 2024. 14% said the Fed cut will come in 2025, and only 2% said there will be no Fed rate cuts in the next 2 years. I do believe we're probably going to get a rate cut here in the fourth quarter of 2024. I'm thinking November or December. Those people that think we won't get a rate cut, they're a bit ill-informed. The Fed want to cut rates. Now, looking at the S&P 500 this week, yesterday on Thursday, guys, we got a bearish engulfing candle. Essentially, that is a gap up above the prior day close, and then we actually sell off and close below the day prior. So we engulf the entire day's range the day beforehand. And now I got some data here for you guys as to what we can expect after the S&P 500 gapping up to a 52-week high and then having a bearish engulfing candle on the same day. And quite frankly, the 52-week high is probably the component you want to look at over the bearish engulfing candle. There's many short-term things that can affect market sentiment, but a 52-week high is a very, very bullish indicator. And looking at the average return, you could see that 1 week, 2 weeks, 1 month later, we actually get very average, probably sideways price action, 0.2, 0.4, 0.7% in returns. A little bit better here 1 month later on the median, 1.4% returns, but then it does get better thereafter. 1.9% 2 months after, 3.5% 3 months after, 7.1% 6 months later, and then 12 months later, 15.1%. And that's why I say the 52-week high is you really should look at, because a single candle on a single day is just noise in the larger price action of the S&P 500. But a 52-week high, that's kind of a big deal. And that's why you want to ignore the short-term noise, look at the overall price action picture, look at the macro, look at the fundamentals, not what's happening in the here and now, and stay long, because new 52-week highs normally beget more 52-week highs, because momentum brings momentum. And looking 6 months, 12 months out, you'll actually get outsized returns on a very high hit rate, 80, 90, and 78% 3 months, 6 months, 12 months later. Now let's switch gears and talk about earnings. Global earnings. This is the global earnings revision ratio. In May, the global earnings revision ratio improved from 0.81 to 0.82 ever so slightly. So what this means is that earnings are actually getting revised to the upside, and they're still very, very good. Now looking at this graph, you can actually see this is the zero line. So this means earnings are being revised positively, and ever more so positively, sitting at about the average revisions ratio. And in a market where people thought we were going to have some of the deepest recession, stagflation, hyperinflation, a weak labor market with immigration, etc., to see this is actually a really, really positive sign. So what are companies doing with all of the cash they have and all of the cash they will have? Well, dividends just hit a record. Dividend payments from US companies just hit a new record of 164.3 billion in the first quarter, up 7% from a year ago, according to the latest Janus Henderson Global Dividend Index released Thursday morning. So companies are looking at dividends, they're providing value to shareholders, and from the famous line from Jerry Maguire, corporate America is showing investors the money. And it's not just in dividends, it's also in buybacks. S&P 500 annual buyback executions are expected to grow 13% here in 2024 2024, and then a further 16% in 2025. And at the end of the day, the only way buybacks grow is if earnings grow. And this just goes to show that investment firms, Goldman Sachs, do expect earnings to grow in 2024. We have seen that, but also in 2025, approaching nearly $1 trillion in share buybacks. That's double-digit growth for the next 2 years, surpassing the buybacks we did in 2023, 2022, and 2021. Now, let's actually switch gears and talk about stock splits. Nvidia recently issued a 10-for-1 stock split. They're going to be going from about $1,000 a share to about $100 a share. And while nothing fundamentally changes, this is often seen as a good thing, because why would you split your stock if you don't think it's going to go higher? You want to make it cheaper for retail investors and option traders, and that's generally why you split your stock. Nothing fundamentally changes, but it is a vote of confidence that the stock will go higher. And we can actually see that stocks that split tend to beat the index being the S&P 500. And this is the average 12-month total returns after a stock split is announced. And this is where we are right now. You can see that stocks that split tend to return 18.3% in 12 months versus the S&P 500 at 13.3%. And in almost every single period in history, stocks that split tend to beat the S&P 500. You can see here that all time 24.5% in stocks that split versus the S&P 500 of 11.9%. Now, diving deeper into the data, this is coverage performance of companies that have announced splits since 1980. 12 months plus 25.4, 6 months 13.9, 3 months plus 7.8% return against the S&P 500 of 2.1%, 4.4%, and 9.1% since 1980. So guys, stocks that split are a reason to be bullish, and that's what history tells us. So with Nvidia's earnings behind us, we got a little bit of a note here from BofA's trade desk. They've raised their price target for Nvidia to $1,320. Just for the record, so you guys know, at $1,278, Nvidia becomes the biggest stock in the world. So they're not positioning Nvidia as the biggest stock in the world. They're going above and beyond right here. But let's go ahead and read why BofA have a $1,300 plus price target here on Nvidia. Now see $50 plus EPS power in the next 2 years versus $35 prior. Reiterate buy, top sector pick on Nvidia's unparalleled combination of number one, a turnkey system design that we think can sustain 80% plus market share in AI accelerator market that could double year over year to $100 billion in calendar year 2024. It can double again to $200 billion in 2027 and $300 billion by 2030. That is crazy. Incumbency across a wide range of customer verticals. And number three, consistent roadmap execution, ensuring smooth transition to next-gen Blackwell product, as well as sustained networking growth, Spectrum X to ramp to multi-billion dollars within a year. Demand continues to exceed supply, and this situation could persist at least through most of 2025. According to Nvidia, they said that on their earnings call. Overall, we raised our materially by 12%, 21%, and 21% for FY 25, 26, 27 to 25, 35, and 44 with faster Blackwell adoption, putting 50 plus EPS power on the table within 2 years. Absolutely nuts. Implying stock is still very reasonable at 20 times PE. We raised our price outlook to $1,320 from $1,100 on unchanged 37x 2025 PE, in line with Nvidia's historical price to earnings multiple. They go on to say, Nvidia is not just growing sales faster than any other mega cap, Q1 sales up 262%, but also generating 57% free cash flow margin. At this pace, Nvidia could generate over $120 billion in free cash flow over the next 2 years, over $200 billion in free cash flow over the next 3 years by 2027, creating strong growth optionality. Second, Nvidia's 40% plus growth in operating expenses for 2024 versus most chip peers constraining OPEX can help sustain its strong competitive positioning. Per Nvidia, every $1 of CapEx generates $5 of hosting revenue in 4 years for customers. So strong return on investment, absolutely crazy. But it's not without any risks. Gross and operating margins are likely at peak levels. That's actually what I said on Wednesday when Nvidia dropped their earnings. We believe 75% GM, gross margin, and 65% EBIT, earnings before interest and tax margins, could mark the peak for this cycle unless Nvidia can supplement hardware sales with an increasing software pipeline, Autos Enterprise Omniverse Gaming. Second, the transition to Blackwell will require changes to data center for power cooling, etc., which could create lumpiness in quarterly execution for a very well-held stock. Pretty much what BofA is saying right here is that the market will continue to grow, there is strong demand, margins are likely at their peak but still very, very strong, and free cash flow is going to power forward CapEx because for every $1 they spend, they get $5 back within a 4-year period. In other words, buy on 2025 earnings. If things go according to plan, Nvidia is still cheap at 20 times. Absolutely crazy what this stock has done to the market in the last couple of years. And just to think that 24 months ago, it was down 50% from its highs in 2022. Now let's talk a bit about the economy. This is the Fed's GDP now, their estimate for the second quarter 2024. I know I showed you it earlier on in the week, but it's sitting at about 3.5, 3.6% here, which is very robust growth for the economy. And the reason why this is quite high actually has to do with a bunch of factors. The first one being NFP gains. Now the market has experienced quite robust job growth in January, February, March, and April this year. However, growth is expected to decelerate over the coming months, and it should level out at the 150K in job gains every single month. And this is actually a healthy figure because it shows that the jobs market isn't extremely hot. It should cap wage inflation, but it's also above the current short run break-even rate, this red line right here, which is essentially the job growth needed to maintain a healthy labor market. So even though things are decelerating, we're still well above the current break-even hiring pace, and it does point to a jobs market which is cooling but still remaining relatively robust for a strong economy. At the same time, household income should grow at a healthy pace in 2024 due to those continued labor income gains. You can see here that real disposable personal income and real employee compensation, this is Goldman Sachs forecast, and income growth should remain relatively healthy. You can see here in the second, third, and fourth quarter, in every single metric apart from real employee compensation in the second quarter, real disposable income and real employee compensation is expected to grow at or above the 3% mark. And take into consideration, this is adjusted for inflation. It's the actual real number right here. So this is very, very healthy. And essentially the data right now is telling us that there are jobs available and those jobs are growing wages above the rate of inflation. At the same time, real income growth forecast across every single quartile is expected to be about 2.5%. Again, very healthy. Now there are risks to this market. Rising credit delinquencies signal some stress, especially among lower income borrowers. You can see that account closures under 680 credit scores have actually risen quite substantially here in 2023-24. But if you look at the 680 to 760, 760 and above, that has actually moved down in a material way. But all in all, the credit card delinquency rate is actually increasing. And if this does continue, it probably will slow credit growth, but that shouldn't have any tangible effect on overall spending. Slower credit growth actually suggests the risk to overall spending is quite small, simply because revolving credit as a percentage of disposable income is actually sitting at historic lows. Now, I know the chart says 1900 every single year, but this gray line right here is actually the 2020 recession. This right here is actually the 08 recession, and this right here is actually the 2000 recession. And then the dotted line extrapolates the growth from the last 12 months into the next 12 months. And you can see here that revolving credit as a percentage of disposable income is expected to increase, but this is actually more of a revert back to the mean more than it is blowing it out the park. Also, growth in consumer credit as a share of growth in consumer spending over the last 12 months has actually been decelerating and is actually posted some of the lowest levels ever in the last 2.5 years. And again, it suggests that even though credit growth is slowing, it shouldn't have any tangible impact on spending or very minimal impact on spending. Now, looking at Gamma, not much has changed from yesterday in terms of key levels. 5400 is still the core resistance. The put support still at 4950 and 5295 is still the Gamma flip zone. But what we are starting to see is just a lot of negative Gamma coming to the tape. I actually mentioned this too in yesterday's video. I said we do need to be wary because there was quite a lot of Gamma building, particularly below the 5000 strike. And after yesterday's broad-based sell-off, we did see a lot of negative Gamma pull into the tape. And you can actually see the JEX profile right here is actually on the negative side of the chart. So we are in negative Gamma, and it does look like dealers are now positioning for some downside risk, but we do have to look at a lot of things in aggregate. Firstly, the majority of negative Gamma is above the 5200 strike right here. Secondly, the 5200 strike is getting pretty big. I want to see over the next couple of days after Memorial Day what happens to the 5200 strike. Does the 4950 move up to the 5200 strike, or do we keep building out the 5000 and 4950 strike? If we do move to the 5200 strike right here, in terms of the put support moving to this strike, that's probably a bullish indicator, and that's probably going to be our floor. But if we remain in negative gamma into next week with the 4950 put support remaining at 4950, maybe 5000, let's just say in this area, that can have a lot of negative consequences in terms of market magnetism to those strikes. But I think it's all going to depend after the Memorial Day weekend. I think any price action with regards to negative gamma could be just hedging into this weekend, buying a bit of protection. What I really want to see is what happens after next week into PCE and into June when we exit this window of weakness. So take everything with a grain of salt we're seeing in the gamma tape right now. Take this huge amount of negative gamma with a grain of salt. You have to understand that it's not a lot of negative gamma per se. Only once we exit the window of weakness, normally when we get into a new month, we start to see these strikes build up. You can see here that it only takes 250 million to hedge the S&P 500, where normally this would be like 2, 4, 6, and then $8 billion worth of negative gamma. And you can still see that the biggest strike here, the 5400 strike, is still at 1, which is essentially $1 billion to hedge the S&P 500 for every 1% move in either direction from that strike. So with regards to all of this, I still want to be a buyer of dips up until we actually get further confirmation next week as to where the put support is going to officially position itself into June leading up to that OPEX, because that's going to be a big telltale sign as to what's going to happen. So I think we should just take today's positioning with a grain of salt and wait for next week's gamma charts and see what happens there before we make any definitive decisions. But as it is right now, I would say buy dips. And if you are hesitant into this long weekend, just take some risk off the table. But if you've made it up until here, thank you so much for watching. If you like this video, guys, please subscribe, hit that notification bell, like this video, and just leave a comment for the algorithm. It actually really helps me out. Cheers.